All right, we're looking at question 1 here. The weighted average cost of capital for a company with the following information is closest to. So we've got market value of debt, market value of equity. So we'll be using these two figures to calculate the weighting of the debt and the weighting of the equity. That's going to be that weighted average part of this. And then cost of capital part, we're going to be using the cost of debt. So we've got cost of debt after taxes, which is 20%. So since we're given the after-tax number, we can just basically ignore the tax rate for this purpose. If we were just given cost of debt, then we would need to account for that tax rate. And then cost of equity is given. So we're given cost of debt and cost of equity. We just need to calculate those weights and then average that out. So here's what that is going to look like when we go through there. So we're going to have our weight of debt times cost of debt plus weight of equity times cost of equity. So our weight of debt is going to be 4 divided by 4 plus 12. So it's going to be the debt over debt plus equity, and then equity will be 1 minus debt, or we could do 12 over 4 plus 12. So we get 0.25 as our weight of debt. So we're going to multiply that by the 0.2, which is cost of debt, and then add that to 0.75 times 0.11 for our cost of equity and the equity weighting. And we get 0.1325, which corresponds right there with answer B. Question 2. Arrow and Beta are commercial aircraft manufacturers. Kayla Mason is an industry analyst evaluating the financial and operating leverage structures of the two competitors. She has collected sales and cost data concerning the manufacturers in an exhibit. She expects unit sales to increase by 5% from their 2012 level. All right, so we've got sales price per unit here, variable cost per unit. So as a reminder, variable cost per unit is basically going to vary with how many units we're selling, and then total fixed cost is just going to be the same no matter how many units we sell. So we're increasing sales by 5%. So that's going to have an effect on variable cost, but not on the fixed cost. Based on expectations for 2013, Mason will most likely conclude that the change in operating income will most likely be greater for Arrow, greater for Beta, or the same for both companies. So to solve this problem, there's kind of two ways we can go about it. I'll show you the quicker way, which I think is how the CFA would probably prefer you to look at it. So that's going to be looking at degree of operating leverage. So I'm just going to scroll down here. I have the formulas. I'll pull these up a little bit and then we can look at these. So we're going to be looking at the degree of operating leverage. So if we have more operating leverage, that essentially means that we're going to have more fixed costs relative to variable costs, which is what we're measuring here. And if we have more fixed costs relative to variable costs, which means we have more operating leverage, that means that selling more units is going to have is going to lead to greater increase in operating income than a company that has lower operating leverage. And that's essentially because the couple things I hit on up here at the beginning. So if we have higher variable costs, then as we sell more and more and more units, this number is going to go up and up and up and up, so it doesn't really change our profit margin that much. Whereas if we have high fixed costs and low variable costs, then that's when we can sell more and more and more units and our costs stay similar or the same. So we're able to increase that operating income more. So we run this formula. So we've got degree of operating leverage. So that's going to be quantity sold times the price that we're selling at minus the variable costs. So we're going to be plugging in the 50 and 35 and 40 and 30 for each respective company. And then we're going to divide that by the same thing here at the beginning. But then this is where we figure out the operating leverage by subtracting out the fixed costs. So for Arrow, we get 1.875. And for Beta, we get 2. So since Beta has greater operating leverage, their operating income is going to increase. So we'll go with answer B. And so let me pull this in and we can walk fully through all the numbers so we can kind of see how this ends up working out from a math standpoint. So walking through this. So our new unit sales for 2013 are going to be 52,500. So that's going to be the number we used for 2013. And then for 2012, we're going to be using this 50,000 number. So what I'm going to do here is I'm going to calculate the Arrow 2012 operating income and then the Arrow 2013 operating income, and we can see that change from year to year. So for here, operating income is going to be 50,000, which is our units sold, times 50 minus 35, which is going to be our sales price minus variable cost, and then we're going to subtract out the fixed cost. So our operating income ends up at 400,000. Then for 2013, the only thing we're changing, since fixed costs stay, and then our profit margin, which essentially what this is, stays. We're just changing those units. So we get 437,500, and our change is just going to be the increase there. So by having sales go up by 5%, our operating income went up by 9.38%. And then for beta, we're going to run that same thing. When we do that, we get 250 and 275, and we see that change ends up being 10% relative to the 9.38%. So just another way to kind of walk through, show all the math, and see how it works in practice. Answer B. Question 3. Bright Pharmaceuticals has estimated that its new plant will have an NPV of minus 800,000 based on expected cash flows. Bright is considering an additional investment of 300,000 that would give the company the option of abandoning the project if the financial results are disappointing. This option has an estimated value of 1.4 million. The value of the new plant, including the option, would most likely be calculated as. So how we solve this is pretty straightforward. So we're going to take our original NPV, which would be that 800,000 minus 800,000, and then we're going to subtract the cost of that option to us, which will be 300,000. And so essentially that option is kind of insurance for this project. So if it goes poorly, then we would get a payout, which is what this estimated value is of 1.4 million. So we subtract out the cost of the option, and then we add the value of the option. So we go from negative 800,000 and minus 300,000, and then we add in the value of that option of 1.4 million, brings us to 300,000. And again, by buying that option, it's kind of like portfolio insurance or project insurance, essentially. So if the project goes poorly, it can kind of help flip a negative NPV project into a positive one. And the main downside here is that if the project goes well, then we kind of spent this $300,000 on insurance that we didn't end up needing. So that's kind of the downside of why you might not do that. Answer A. Question 4. Which of the following is most likely a duty of the nomination committee? So we've got, when we look at these committees, they're usually pretty literal in what they kind of do. So the nomination committee, it's probably going to be pretty literal in what they do for the board. So we've got A, recruiting qualified board members. This sounds like it could certainly be our answer. Kind of recruiting qualified board members would kind of be synonymous with nominating board members. So we could probably go with A. Let's make sure B and C we can rule out though. B, recording the expenses of board members. That doesn't really jive with nomination, so I'm going to go ahead and rule that out. This is probably going to be some type of like finance or admin function, not nomination committee. And then C, setting the remuneration of board members. So remuneration is compensation, and that's typically going to be called like a compensation committee, something like that. So again, these committee names are usually pretty straightforward, so we can confidently go with A. Question 5. Which of the following best describes fractionalization as used in business models? So we've got A, transferring ownership of an asset to customers with low capital and maintenance costs. So this is going to be describing a leasing model. We're basically transferring ownership over a shorter period of time where the customer is basically going to be able to use that asset. So a pretty simple example is if you lease a car, you're technically kind of have ownership of that asset over the duration of the car lease, but at the end of that, you have the option to return it. And so when you return it, you were basically renting it the whole time. So this does not describe fractionalization, that's leasing, so we can rule that out. B, an alternative to purchasing a product or service where a customer can rent items for a duration of their choice. So in fractionalization, we will have retain actual ownership. So in B, we're renting items. So for that reason, we can kind of go ahead and rule that out. This is referring more so to like a subscription or rental model. So from a subscription standpoint, this could be applied to software. So when you pay for a license to some software, you're essentially renting the right to kind of use the software for the duration of the contract. So we should be going with C. Let's make sure we can pick it. An alternative form of purchasing an asset where value is created by selling an asset in small quantities or using an asset at different times. So this will be correct, and this is kind of what fractionalization refers to. And I think a couple of the examples given were applicable to like real estate or aviation or art, where you can kind of buy, in the case of an airplane, you could kind of become a part owner of an airplane and be able to use it at certain parts of the year, whereas other owners would have certain parts of the year to use it as well. So that's kind of one example of fractionalization, and we'll go with answer C. Question 6. An analyst is considering buying a 1-year call option on a non-dividend paying stock with an exercise price of $100. The current stock price is $95. The stock price is expected to go up or down by 18% in 1 year. Assume a risk-free rate of 4%. The number of units that the analyst needs to buy to create a risk-free portfolio is closest to. So for creating a risk-free portfolio, we're going to be using our hedge ratio formula. And let me pull that in. Oops. Sorry about that. So this is going to be our hedge ratio formula. It's essentially saying what is the value of the call option if the stock price goes up minus the value of the call option if the stock price goes down. So we're going to need to calculate those two values, and then we're going to divide that by the value of the stock price if it goes up and the value of the stock price if it goes down. So these two are going to be pretty straightforward since we have 18% up or down in 1 year. So the stock up is going to be 95 times 18%, and then stock down is going to be 95 times 1 minus 18%. All right, so let's pull this in and we can start showing these calculations. So for stock up, like we said, we're going to be doing $95, which is the current price, and then we're going to multiply that by 8 plus 18%, gives us 112.12. So that's going to be this number right here. And then I'm going to come down here to SD. So stock down is going to be 95 times that 0.82, which equals 77.9. So that'll be this figure right here. So then for call option up, remember we're going to take the maximum for our call option value of 0, or if it's a positive number, we'll take that. And as a reminder, the reason why we do 0 or positive number is because if it's a negative number, we're just not going to exercise it. So if it's a negative number, it becomes 0 because we just don't exercise the option. So our value for call option up will be the stock price minus the strike price. So we got stock price of 112.10. Our strike up here is our exercise price of $100. So we just subtract those two out and we get 12.1. So we're going to take the greater of 12.1 or 0. So we take 0, or so we take 12.1. And then in this instance, we're going to be taking, for call price down, we're going to be taking the max of 0 or 77.9 minus 100. So in this instance, this will be a negative number. So we'll take the 0 for call option down. So when we do that, we plug all these numbers in. We get 12.1 minus 0 over 112.1 minus 77.9. Gives us a hedge ratio of 0.353. So that tells us we need to buy 0.35 units. Answer A. Question 7. Which of the following statements regarding business models is least likely correct? So we've got A direct sales strategy may involve an intermediary. So we can rule this answer out since this is actually a correct statement. And it's confusing because direct sales kind of implies we're selling directly to the consumer. But where there could still be an intermediary is where we have a broker that earns a commission. They never have ownership of the product, so the strategy would technically still be person to person. So think about a real estate transaction. I might sell a house to somebody else directly, but there may be a realtor involved. So the realtor is going to be that intermediary. But it's technically still a direct sale of me to that person. The intermediary is just kind of brokering and taking a commission on that sale. So B, a price taker in a market faces less pricing risk from competitors than a price setter. So this sounds like it will be our answer. And the reason for that is this needs to be flipped. So price takers face more pricing risk because they have no, it's right there in the name. They take price that the market gives. They don't have any ability to kind of like adjust price up or down. So they have a lot of pricing risk. If the market is dictating lower prices, then that might cut into their profit margins. Whereas a price setter is going to have a lot more pricing power to kind of move prices up and down based on their costs and what profit they want to make. So they're going to be the ones facing less pricing risk. Let's make sure we can rule out C. A business model helps analysts understand the total available market and inherent risks. So this will not be our answer since, yes, this is a true statement as well. So we will stick with answer B here. Question 8. Which of the following business structures most likely has a legal identity? So we've got A, limited companies, B, limited partnerships, or C, general partnerships. So by legal identity, it basically means, is there some form of structure that kind of separates the company's assets from the person's assets or ownership's assets? And so when we look at it from that perspective, limited companies, A, yes, these definitely have legal identities. If you look at a publicly traded stock, for example, I mean, there's anybody who can open a brokerage account and buy a stock on the stock exchange is going to have ownership technically over a company that they're buying. But the company owns all the assets. Just because I have ownership over certain assets or have ownership over a stock doesn't mean that I'm going to have any control or liability as well related to those assets. That's the main thing, is the liability. So if I own Apple stock and Apple gets sued, I'm not going to be personally liable for that. So that's the big thing there. So it looks like A will be our answer, limited companies. So limited partnerships. So partnerships consist of LPs and GPs, so limited partners and general partners. There's a distinction over who has liability. So limited partners don't have liability, but there's not some separate entity related to it. The GPs do take on personal liability though, so there's really not a legal entity related to them. And then that kind of filters down into answer C as well. So general partnerships. The GP does have personal liability there. So there's no legal identity separating the assets. And that's the key thing to drive home here, is it's the separation of personal from ownership, or the company's assets by the owners. Answer A. Question 9. Rector Incorporated is a manufacturing firm with a capital structure comprising equity and debt. The current market value of equity is $2 million and the beta of the stock is 1.2. The company has outstanding bonds amounting to $4 million in face value, which pay semi-annual coupons at an annual rate of 8%. The yield to maturity is 9%, and the remaining term to maturity is 5 years. The corporation pays a tax rate of 25%, and the equity risk premium and risk-free rate are 4% and 2%. A lot of information there. Rector Incorporated's weighted average cost of capital is closest to... Okay, so for weighted average cost of capital, we're going to be taking the weight of equity and the weight of debt and then multiplying those by the cost of each. So let's pull in everything that we're going to walk through here, and then, let me move that down, sorry. We'll start pulling all the numbers in for this. So we're going to be looking at the weight of debt times the cost of debt plus weight of equity times cost of equity. So we're not given any of these numbers, it looks like, so we're going to need to go ahead and kind of calculate all of them. So let's start walking through that. So the weight of debt, we have market value of equity of $2 million and debt of $4 million. So we're going to be using, our weight of debt will be 4 divided by 4 plus 2. So it's going to be basically how much debt do we have related to all of the capital in the capital structure. So we get 2/3 or 0.666666 infinitely, or you have to round at some point. So we'll do 0.6667. So we've got our weight of debt. cost of debt now, we're going to be using this yield number. So our 9% yield to maturity is going to be our cost of debt. And that's the cost of debt because that's what the yield to maturity is what you would be issuing debt at today if you wanted to issue more debt. And then we need to, because we can write off interest expense, we do need to take into account the tax rate. So we'll do 1 minus the tax rate, which gives us a cost of debt. We're given the tax rate here at 25%. Gives us a cost of debt of 0.0675 or 6.75%. Weight of equity is just going to be the opposite of weight of debt. So we have 2/3 for debt, 1/3 for equity. And then cost of equity, we're going to need to use the CAPM formula. So we're given the risk-free rate and beta and equity risk premium. So risk-free rate is 2%, equity risk premium 4%, beta is up here, brings it to about 6.8%. So a lot to do there in calculating all these different numbers, but then at the end we're just going to plug those in, and when we get that back, we get that weighted average cost of capital of 6.77%, or answer B. Question 10. A security market index represents the A, risk of a security market. So typically our security market index is going to be representing the value of some group of securities, not necessarily the risk of those securities. A lot of times we'll be able to run some type of risk statistics to look at the value of those securities over time to kind of maybe understand the risk of the market. But the index itself isn't necessarily telling us any information about the risk. So I think we can go ahead and cross off A. Let's look at B and C. B, the value of the security market as a whole. So it could, if that's what the security market index is representing, if we're looking at a total market index, then that is what it could be, but it doesn't necessarily have to be every securities market index. So B could be our answer. Let's look at C and see if that makes more sense though. C, value of a given security market segment or asset class. So this is going to be a better answer than B. And the reasoning there is, like we said, the security market as a whole, that could be a security market index. That would be something like the MSCI ACWI that kind of captures all stocks throughout the world. But we can also have indexes that represent specific sectors or industries or asset classes. So you have like the S&P 500 for large cap stocks in America, or you have S&P 500 real estate, which is the asset class or market segment. So we can have indexes representing a lot more than just the market as a whole. So we'll go with C.